I'm Ian Castle, founder of MicroCapClub, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, MicroCapClub is where you belong. Join us.
All right. Welcome everyone to our 28th business breakdowns with Ascent Industries. Before we get started, I want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. MicroCapClub is not a registered investment advisor. MicroCapClub, its partners, members, subscribers, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the MicroCapClub community for tuning into this business breakdowns conversation with Ascent Industries CEO Brian Kitchen. Brian, welcome. Thanks for joining us.
Thanks a lot.
My tag team partner for this business breakdowns is Sebastian Krog. Sebastian is a private microcap investor and author of the Treasure Hunting Substack. Sebastian has been a MicroCapClub member since 2021. Thanks also for joining us, Sebastian.
Thanks for having me.
As mentioned, the business we are breaking down today is Ascent Industries, which trades on the NASDAQ under the symbol ACNT. Ascent was originally profiled in 2023 by ODC. Ascent Industries, which was previously Synalloy Corporations, is a specialty chemicals company that has emerged from a multi-year turnaround following a proxy contest and the sale of their stainless tubing business in June of this year. Today, the chemicals business produces specialty chemicals for a variety of end markets and industries, and Ascent operates 3 manufacturing sites in the southeastern U.S. near Tennessee and North Carolina. Ascent can be viewed as the company that cleans up the breadcrumbs of the larger chemical companies. They have a high degree of recurring revenue from blue chip customers, as the chemical processes are too niche and not scalable. From here, the cash from the steel asset sales will be redeployed into the higher margin specialty chemical segment and strategic acquisitions with increased emphasis on branded products, which will be central to the company's go-forward strategy. So before we get into the presentation, Brian, I'd just love to hear a little bit more about your background. Can you tell us what brought you to Ascent and kind of what was attractive about the opportunity?
Yeah, you bet. So, I've been in the specialty chemical industry for, 25 years now, give or take. Prior to joining Ascent, Ryan Kavalauskas, our CFO, and I worked for another smaller specialty chemical company based out of Charleston, West Virginia. And that's really kind of where we cut our teeth from a turnaround perspective. Prior to that, I'd worked for Dow AgroSciences, now Corteva, and then Dow Chemical for a number of years. But, prior to joining Ascent, we joined a company that was losing roughly $8 million of adjusted EBITDA. Fast forward with a lot of blood, sweat, and tears, 4.5 years later, we had turned that around and got that to about $36 million of adjusted EBITDA on a trailing 12 basis. So pretty significant turnaround in a pretty short period of time. During that period of time, we were on the verge of BR on a couple of occasions. So that's really kind of where we cut our teeth from a cash management perspective. That's where we cut our teeth from a turnaround perspective. So after the sale, we kind of took a pause and said, okay, if we had the opportunity to do this all over again, what would we do differently? And that's really where the Ascent opportunity kind of came up. Did some diligence. I like I said, I'd been in the industry for a number of years, had never heard of either Synalloy or Ascent. Leaned in, did some diligence, and what I saw was a company that had really good bones and just needed a strategy. So leaned into the opportunity, joined to run the specialty chemicals segment, and about 3 or 4 months into that journey, got a call from a chairman who said, "Just kidding. Can you please take over the full company?" So that's a little bit of the background. We'll get into a little bit more of the history here in a few slides, but that's the backdrop.
Excellent. Thank you very much. So with that, I would like to pass the mic to Brian to go through the presentation. As a reminder to listeners, feel free to post your questions in the Q&A box by clicking on the bottom of the screen. And Brian, the floor is yours.
Okay, great. Really appreciate it, Adam and Sebastian. So just fair warning, I've had several investor conferences over the past 3 to 4 weeks. So if I'm going too fast, Sebastian, Adam, you're going to need to jump in and kind of rein me in a little bit here. So just to kind of get started, I do think it's important to take a look back at the history of the company. So We have been around for 75 years. We actually started off as a specialty chemical company, Blackman Euler, back in 1945. And about 20 or so years into that journey, there was a decision made to diversify the portfolio. And that's when we acquired some stainless steel tubular manufacturing assets. And, for the past number of decades, we've been operating under two different segments: specialty chemicals and stainless steel tubular assets. Obviously, that's a little confusing, right? Because there's not a lot of synergies between those two segments. So when I had the opportunity to join back in early 2024 into my current role, one of the first things that we did from a board perspective is we took the strategic decision to move forward and optimize the portfolio. And we'll get into that a little bit deeper here. But today, we stand as a laser-focused, pure-play specialty chemical company without the legacy distractions of operating two different segments that have absolutely no synergies between them. As I mentioned before, Ryan Kavalauskas, our CFO, and I've had a number of years in working together, roughly 10 years. We worked together at Angus Chemical Company, now Advancion, followed by Clearon, and now Ascent. And one of the first things that we did when we moved into our current roles is we effectively put the band back together. And what I mean by that is, we reached back out into our network, grabbed a number of the individuals that were, played material roles in our turnaround at Clearon, as well as other stops along the way. And we brought them in, we gave them the keys, and we told them to go do what they do best and not wreck the car. And in effect, what they did was just that inside of 2024. We delivered some pretty strong results in that first year, roughly a $20 million turnaround from an EBITDA perspective, generated a fair amount of cash, roughly $17 million from operations, some really strong gross margin improvements as well. So, last year for us was all about stabilizing and fixing the foundation, laying the groundwork not only for an improved quality of business in the specialty chemical segment, but also readying the stainless steel segment for an eventual sale. So very proud about the results that were delivered last year. Obviously, no ticker tape parade, but that really set the stage for 2025. Our operating model that we have today, it's all centered around chemicals as a service. And I'll unpack that a little bit more in a few slides from now. But effectively what that means is we come alongside of our customers and we meet them where they are and we meet them how they need to be met. So whether they're looking for support from a formulation perspective, maybe they need technical support to help them solve their most difficult problems. Maybe they need differentiated supply chain solutions. Maybe they're just looking for someone to provide them what they want, when they want it, and how they want it, versus going through, the legacy value chain, the legacy chemicals value chain that's really remnants of 1990. So we take great pride in meeting our customers where they are and really tailoring our offerings to meet their business objectives. And we come alongside of them and we delight them in those moments that matter. So for some customers, those moments are development related. In other instances, they're commercial related. In other instances, they're really manufacturing and support related. So, a fair amount of momentum is being built up. We're seeing very good progress in our marketing and sales strategy, and we're just beginning to drive growth. When you take a look at Ascent today versus other chemical manufacturers or other toll manufacturers or custom manufacturers or distributors, we do offer a more comprehensive set of solutions across the board. So yes, we're actively engaged in product or process development. We absolutely engage in scale up of new products, either products that we develop or products that our customers have worked to develop, but they have not yet brought to full commercialization. We do reactions, we do blending, we do warehousing, logistics, regulatory, and the like. And really what that means is not only are we a chemical manufacturer, but we're also providing that level of service that's more representative of classical distribution as well. So, we've been very successful over the past, 6 months in bringing on new customers and meeting existing customers in different ways. kind of in that small to mid-sized customer base, where many of them will approach larger chemical manufacturers and say, hey, I have a problem, can you help me solve it? And really, for the larger chemical manufacturers, they're operating continuous processes. They really don't want to allocate the resources to solve smaller problems. We lean into that. We lean in hard. And by doing that, number one, we develop an incredibly sticky customer relationship. Generally, what we walk away with is demand that's more ratable, that's more predictable, and generally more margin accretive. So that's the model that we have today. We're actively deploying that. We're beginning to bank some pretty new and interesting wins. In addition to that, I would say that our business model is also very differentiated. So, if you take a look back to 2023, roughly 90% of our sales were structured around toll manufacturing and some custom manufacturing. But basically what that meant was customers were calling us and saying, hey, can you make our product inside of your equipment? And we would do that, right? But generally, again, not ratable, not predictable, and not margin accretive. But one of the things that we saw when we did our diligence on Ascent was, well, actually, there's a product portfolio that's been up on the shelf, effectively collecting dust. So, one of the things that we did last year is we breathed some life back into that product portfolio. And by the end of the year, we had changed our mix from 90%, toll manufacturing or custom manufacturing to 10% to 75%. Last year, shifting our product sale mix to 25%. So along with that, you saw an improvement in price, you saw an improvement in gross profit, gross margin as well. So we're excited about that. But then we also have a model where we buy, build, and operate dedicated manufacturing plants for customer-specific needs. So it's not a unicorn. That's not a twinkle in the eye. That's not a maybe we might do this at some point in the future. That's something that actually happens today. We actually have two of our plants, 2 of our 5 plants are dedicated to specific to customer-specific products. So as I mentioned earlier, we started off in 1945. We've got about a couple hundred employees today. 170 or so customers, 3 manufacturing sites, right? 5 plants spread across 3 sites. Yes, we're in that Southeast corridor, as Adam referenced earlier, South Carolina, Tennessee, Virginia. Really good plants, really well maintained, differentiated capabilities. Roughly 95% of our top line today is supported with domestically sourced raw materials. So as there are changes in the tariff landscape, we're pretty well insulated, and because we're insulating our customers from that price structure variability as well. Our top line from a chemicals perspective, it's in that $75 to $80 million mark on a 2025 basis. So, we're relatively small today, but we have some pretty strong growth runway ahead of us inside of our existing asset base, and I'll touch more on that here in a minute. So where do we participate? So we participate in an array of different markets. And what I would say is, over 15 markets is where we've historically participated in. And I would say it was generally without purpose. So one of the things that we did last year is we really kind of took a step back and determined, where do we really want to play? Where do we have that right to win? So if you think in terms about how big is this market? Well, the U.S. specialty chemical market's over a $200 billion market, so incredibly large. But if you pair that back and you say, well, how big is really the addressable market just through the lens of the products that Ascent manufactures and sells today? That market is roughly a $9 billion market. You say, okay, well, how's that made up? Well, let's say a third of that is related to coatings and adhesives, sealants, elastomers, or better known as CASE. Within the industry, a third of that, give or take, is really related to HI&I. So think cleaning applications. Another third is things like that go into the oil and gas or the energy markets, and then the balance of it goes into a wide array of other segments like textiles and water treatment and pulp and paper. So we've really narrowed in on kind of our pillars of focus to be oil and gas, coatings, adhesives, sealants, elastomers, HI&I, and then the natural adjacency to water treatment. That doesn't mean that we run away from other opportunities that are brought to us by customers who have expressed needs. That just means this strategy is helping inform how we deploy resources moving forward. One of the things that we did last year, and I mentioned this a little bit earlier, is we really worked on refining our mix. So moving from that 90% custom manufacturing, 10% product sale to that 75% custom manufacturing, 25% model result that we delivered last year. You can see that's had a very favorable impact, not only on our price, but also on our gross margin profile. And look, what I would say to the audience is, we're not running away from custom manufacturing at all. There's very good quality business to be had in that in that custom manufacturing space. What I would say is, we're running away from bad quality business, right? We're upgrading the quality of business that we have across the entire portfolio. I mentioned earlier that we've got a fair amount of runway for growth inside of our existing asset base. And so just roughly speaking today, we're roughly 50% utilized across our 3 assets. Some more, some less, but on average, it's about 50%. So that's both the bad news and the good news, right? So bad news from an absorption standpoint, right? But the good news from an upside standpoint. And we can grow inside of that existing asset base with very minimal capex requirements. You see on the right-hand side of the slide here, our ongoing capex requirements, in the range of, $1 to $3 million a year, over the past 4 or so years. And we don't believe that that's going to materially change as we look out into the future and drive greater growth inside of the existing assets. And I want to be clear, right? That doesn't mean that we're running the plant with duct tape and popsicle sticks. We're absolutely not. Safety is absolutely at the core of everything that we do. Compliance is absolutely at the core of everything we do, right? It's our license to operate. And look, from a reliability standpoint, we are not going to flinch on delivering the required reliability to delight our customers on a daily basis and earn greater share of wallet in the future. So minimal capex, high service levels, tons of runway for organic growth inside of the existing asset base. So, we're really at an inflection point, right? So from a first half perspective, I'd say, look, we made a lot of progress last year on optimizing our cost structure. So on a 2024 basis, we pulled out roughly 20% across labor and overhead. We pulled 20% out on raw material costs. We've made a lot of improvements from an SG&A perspective. We've purposefully recapitalized SG&A, and that's not code for we're spending more on SG&A. We've just reallocated where that SG&A is being spent. And cost management is still very near and dear to our heart. We're continuing to pull on the levers that we can to optimize our cost structure. And you can see that that's true in our first half results, right? We drove a 24% reduction in our COGS versus the first half of last year, drove some nice increases in adjusted EBITDA, and we generated a fair amount of proceeds from our stainless steel tubular asset sales, roughly $60 million. And we've done all of that while still keeping a watchful eye on working capital as well. So, we're focused. The foundation has been laid for us moving forward. It's about growth, and growth. So let's talk a little bit about both growth and catalysts. So from a catalyst standpoint, I mentioned earlier that we divested of all of our operational assets within the stainless steel tubular segment earlier this year. We do have one last remaining holding that's effectively an empty manufacturing plant. That site has been empty since August of 2023. We sold all of the related equipment back in 2024 for about $2.8 million worth of proceeds. But we still have the building, right? It's under a sale leaseback transaction. It costs us about $2.1 million a year for rent, utilities, insurance, and the like. So obviously that's a drain, and we're hyper-focused on addressing that. What I would say is, we have line of sight to transacting on that in partnership with the property owner by the end of this year. Okay, so let's talk about growth. Let's talk about inflection point. Let's talk about what we've done up until now. So in the first half, we drove some pretty meaningful. We secured some pretty meaningful new pieces of business. We had over 50 projects, pulled in some pretty nice revenue growth. The sales cycle time that we delivered is a little shorter than what we typically see, so 2.7 months versus our typical cycle time that ranges anywhere from 3 months to 12 months, depending on the product complexity, depending on the application, depending on the customer qualification timeline. In the first half of this year, you can see that roughly 77% of all of the new wins came directly from existing customers. So we've expanded share of wallet. And I want to be clear, this is not the market turning around and the market doing us any favors. Quite frankly, the market is not turning around. The market's not doing us any favors. So anything that any new opportunities that we win, it's really a function of just a lot of aggressive self-help. And that's the messaging that we communicate every single day to our employees. Similarly, right, we've also been successful in winning new customers, right? 23% of the new top line growth that we delivered in the first half was from new customers, and the profitability profile across both of those is very compelling, right? You can see greater than 25% EBITDA margins across both. So the engine is beginning to fire up. Remember last year, we recapitalized SG&A. We brought in an entirely new sales force. We stood up a marketing function that didn't exist, and it's taken time to really build up that momentum. And I believe now we're getting to a point where we're at a true inflection point. So if you look at the bottom chart here, you'll see that there was a 45% increase in our selling project pipeline from Q1 to the end of Q2. So at the end of Q1, our selling project pipeline was roughly $45 million. At the end of Q2, we added on another $25 million of high quality projects. And I want to be clear, right? So, let's talk about what makes its way into our selling project pipeline and what doesn't. So number one, screening criteria. Have we ever made this product before? Yes or no, right? And if the answer is yes, awesome. We move that in. Screening criteria number two is, do we have the capabilities, right? Do we have the capabilities to make this product? And if the answer is yes, we move it into the pipeline. And underpinning all of that is an expressed customer need. So what's not in the pipeline are wild and crazy ideas. If we only had product XYZ, I think I might be able to sell it to these 32 different customers, with an addressable market of 50 billion or things like that, right? These are specific and actionable and measurable projects that make its way into the pipeline that the team actively efforts to move along the process every single day. So of the new $25 million worth of projects that were brought to the table inside of Q2, those are all addressable. Those are all winnable in the second half of this year. So we're very optimistic about the momentum that's being built up across the sales and marketing organization. We would love for the sales cycle times to be much shorter than what they are, but that's really a function of the general sales cycle that we're operating within. Now, here's the good news. The good news is once we do lock in a piece of new business, generally speaking, if it's on the custom manufacturing side, it's generally very, very sticky. And even on the product side, especially when we're grabbing an existing product off the shelf and then we're customizing that product specifically for a customer specific application, that's also incredibly sticky. So that's why when we talk about delighting the customers on an ongoing basis, it's not just about winning the sale. It's about how we service that sale from start into perpetuity. Let's talk about kind of what we're building here. So from an overall business perspective, longer term, think 35% gross margins, think 15% SG&A, think 15% EBITDA margins. That's really what we're running and gunning towards, and that's not based on a twinkle in the eye or a unicorns setup. Really, that's based on, if you take a look out at the specialty chemical landscape, that's within the realm of what other peers are delivering today. So realistic and feasible. We made some good turnaround movement last year. There's a lot more runway for growth organically inside of the existing asset base. We can take our top line from $75 to $80 million, punch it to 120 to 130 inside of the existing asset base. That number is risk adjusted, right? That is risk adjusted just based on maintenance and clean outs and other things that do drive downtime. So with operational excellence, there's a possibility to punch even north of that as well. And there's also the lever around inorganic growth as well. So today we do have dry powder. We've actually in the first half of this year bought back about 6% of our outstanding shares. So we've got about $60 million even after buying back about 6% of the outstanding shares. So plenty of firepower. That's not code for we're going to go out and buy things just for the sake of buying things. But we do have firepower to invest inside of our existing asset base for great new growth opportunities that maybe we don't have the required equipment for, as well as inorganic growth opportunities. And really, this just kind of touches on that. So $60 million cash on hand at the close of Q2. We do have debt capacity, not that we think that we're going to need to pull on that lever at any point in the near future, but that is within our control. So, are we active in looking from an M&A perspective? The answer is absolutely yes. We are. What are we looking for? So we've got several different strategic filters that we pass opportunities through. Number one, does it fit from a market focus standpoint? Number two is there's a geographic element. Does it check the box on some things that we're looking for? And number three, does it enhance, right? Does it enhance our existing capabilities? So once we have opportunities to pass through that filter, we begin to effort that. Now, what kind of multiples should we be thinking about? For non-distressed assets, think multiples up to an 8x pre-synergies. Post-synergies, that should translate to something around that 6x type of range. That's not code for we're running away from distressed asset or turnaround type setups. Quite frankly, we love those, right? But for us, it's all about the timing. So what we don't want to do is add something to the portfolio or to the platform that further compounds our existing problem statement. We have low utilization today. Do we really want to go acquire something today that also has incredibly low utilization? I would much rather do that when we reach a point from an asset utilization standpoint when we're operating at that 75% utilization rate. That's the time for us to really go stitch on that next distressed asset, turn it around and turn it into a cash register. So that's the brief overview of Ascent, who we are, where we're going, how we're doing it. Like I mentioned earlier, for me, being able to kind of quote unquote put that band back together, that's just been a massive accelerator for us. Really proud of the work the team did last year and then rolling into this year with portfolio optimization. Really now it becomes about execution of our growth plans moving forward. The balance sheet is clean. We've got cash. We bought back shares. We're pulling on all the right levers, and now we just have to execute. So Adam, Sebastian, I'm going to take a breath. I know I went pretty fast. No one jumped on me and said slow down, so I hope that was okay.
Excellent. Thank you very much. That's a great overview of the company. Lots of interesting things to dig into. We'll move into Q&A now. As a reminder to participants, if you have a question, you can enter it in the Q&A box at the bottom of the screen. I will kick things off and then pass it over to Sebastian. So let's start here. So after you became CEO, can you just talk a little bit about, you went through this turnaround process. Can you just talk a little more about the key hires you made after becoming CEO, what roles they were, how they've impacted the business, and where do you feel you are in that process, maybe on the people side?
Yeah, no, it's a great question. So, one of the first hires that we made right out of the gate, outside of bringing Ryan on as CFO, was strategic sourcing. And one of the reasons why we did that is because what we saw were three different plants that were almost operating as three different standalone businesses. No synergies were being exploited across them. So we brought in a strategic sourcing professional that basically began to aggregate all of the buys and then begin to execute, develop and execute a strategic sourcing strategy. And as a result of that, we saw a 20% reduction year on year for raw material costs, right? So huge lever. We knew that right out of the gate. One of the first hires. Another critical hire was our VP of Sales. Again, worked with us previously. Tons of great work, a lot of great experience, both in multinationals as well as local players. Our general counsel and regulatory lead worked with us previously. Who else am I missing? Our VP of Business Operations, so think all things back office, IT, customer care, planning and scheduling, all of the basic foundational things that folks often take for granted. He joined. He actually was my intern many moons ago back at Dow Chemical. So we've really assembled a cross-functional team across all disciplines. And we've got a really well-rounded management team at this stage. From a SG&A perspective, what additional levers are we looking to pull on? I would say that we're always looking for great sales talent, both technical sales as well as inside sales. So we'll continue to add to that complement as needed. But for right now, after rounding out the R&D leader role, I think we're in a really good position to go out and keep building on that growth momentum.
Okay, great. Excellent. And then this is a business that has operating leverage inherent in the model, and you talked a lot about underutilized capacity. Can you just dig into that a little bit further? So on the EBITDA margin growth slide, I believe the bulk of contribution there may come from increasing that internal capacity. Where do you feel you are in that process? What's the timeline like there? And how can you kind of get additional throughput over time?
Yeah, I mean, it all starts off with the selling project pipeline. So, that $45 million of selling projects that we had in the pipeline at the end of Q1, added to that the $25 million that we've added in Q2, that we're not going to win all of that. So the size of the overall pipeline matters, and the quality of that pipeline matters. So that's what the team has been hyper focused on building over the past, I would say, 6 to 9 months. And we're now at a point where some of these opportunities that we've been efforting for 3 months, 6 months, 9 months, a year are really beginning to pop. And I'll give you just a real life example. Over a year ago, we started working on an opportunity with a foreign company that was looking to localize their supply chain in the U.S. literally over a year ago. And last week was our first commercial scale production run. And moving forward, that's going to be 400 to 600 metric tons a year of net new business, a couple $1 million, really strong gross margin. So, these opportunities do take time. And, once they start rolling in, that's going to start having a very favorable impact, as it flows through the income statement. So, do I expect anything, a material change in the back half of this year, in the final quarter of this year? No, I don't. But I do expect that as we roll into 2026 and some of these new pieces of business that we've locked in, I do expect them to hit full run rate inside of 2026. By when will we get to that $120 to $130 million range? I would say conservatively, that's going to be, 2030. I would tell you internally, that's absolutely not our goal, right? I would be disappointed if we're not there, by that 2028 genre.
Okay, gotcha. That's helpful. Thank you. Last one from me, and then I'll pass along to Sebastian. So, and hopefully we can get some questions from the audience. So on the dedicated plants doing customer specific products, can you just talk about the contract duration there? How much of that is recurring, and maybe the profitability profile of that business?
Yeah. So, I mean, you can imagine when you build a dedicated manufacturing facility, that's not for, a month. That's not for 6 months. It's multi-year. And in fact, with these customers that we're working with, we've had, multi-decade relationships with them. And I don't believe that that's going to change. We actually signed a contract earlier this year. We issued a press release, immediately thereafter that, indicated we signed a new four-year agreement, and that resulted in actually a $750,000 price pickup on an annualized basis. So not only are we, maintaining those agreements, but we're driving better quality of business through that contracting process. And that's really just a function of the quality of people that we're bringing in and our ability to do market research and understand the relative value of our products in our customers' products and processes.
Gotcha. Great. Thank you. Okay, perfect. I will hand it off to Sebastian now. And like I said, then we can get to some audience questions.
Great.
Perfect. Thank you, Etta. Yeah, thanks for the presentation, Brian. So I think I'm just gonna maybe touch a bit more on the theme of the turnaround you're driven so far since you joined Ascent. So I think it's kind of a two-step turnaround. First was obviously to shut down the steel business, and but then there's also a turnaround within the chemical side, right? So I'm just curious. I think when you joined Ascent, maybe you can talk about, we saw it in the numbers, a lot of revenue, a lot of projects were probably not even profitable. So did you walk away from those? Did you renegotiate these? How did you go about kind of improving the gross margin from your from the past?
Yeah, when you walk into a business and you ask, what markets are you participating in? The answer is I don't know. You know that you have a problem, right? So one of the first things that we did is really try to wrap our arms around the profitability of all of the business that we had across the entire grid. And yes, we took some pretty aggressive pricing action, but through that process, we also identified a lot of business that we had that, quite frankly, we were priced below our variable cost, which kind of makes your head explode. And you say, well, why? And how did they get to that point? But none of that really matters. It's all about what do you do moving forward. So, we partnered alongside of our customers. We raised price when and where we could, and where we couldn't, we gracefully deselected that business. And as a result of that, you saw the quality of that business improve, over time. Right now, we're operating in the 25 to 30% gross margin range. So pretty significant improvements in a pretty short period of time. The other thing too is just that mix. So one of the levers that we pulled on last year was really shifting that mix. Trying to fill in some of the gaps of the business that we deselected, and are really moving towards products. Those are generally more quicker wins for us to get versus the longer sales cycle times that are accustomed to custom manufacturing. So those were some of the commercial levers that we pulled on. Obviously, along with that is working back with our customers that we've been engaged with for many years, trying to unpack where are there additional opportunities for us to grow, how can we come alongside of them and satisfy unmet needs. And that takes time to develop and evolve, because think about it, in some instances when you have a transactional relationship for a year or a decade or 2 decades, to really begin to change that relationship does take time. And we're at a point right now where we're getting very interesting looks from customers that we've never gotten looks from before. They're high quality pieces of business, and it's incumbent on us to demonstrate that we can win.
Okay, and looking ahead and at your pipeline, are there any sectors or industry you think are more attractive, you're more leaning towards to, and what are kind of the margin differences between these sectors you pointed out in your slide?
Yeah, so I mean, like the four segments that I referenced earlier, Sebastian. So the coatings, adhesives, sealants, elastomers family is a segment that we're leaning into to heavy on, and we've seen some early success. Oil and gas was quite frankly a market that was available to us, but up until a year ago, we had basically zero participation or close to zero participation. Really strong runway in that space. HI&I is also another area where we see strong growth runway, but we've yet to really to build strong momentum there. So we're working in those three areas along with the water adjacency. Again, we're not running away from other markets. At the core of all of this is, do these opportunities present a compelling margin profile? And if the answer is yes, we'll lean into them. What we're not going to do is go out and hire 15 different sales folks for every single potential market opportunity that exists out there. We're trying to be very disciplined in our approach of, from a precious resource allocation perspective.
Okay, and in terms of product mix, custom manufacturing versus branded products, I think you're obviously leaning a bit more into branded products compared to the past, but if I get the sense right, the overall mix will still be the majority custom manufacturing. Is that correct? And can you just touch a bit on these two?
Yeah, sure. Look, I think in the near term, I think our mix is probably going to be in that, 65 to 75% custom manufacturing genre, 25 to 35% proprietary products. You're right. Anytime that we can lean in and drive more proprietary product sales, we like that generally because number one, it is more ratable, it is more predictable, and generally more margin accretive. But again, we're demonstrating to ourselves as well as to the investor community that that custom manufacturing can be a really good business for us. It just gets back to the quality of opportunities and how they dovetail in with the asset base. So, I would look for us to continue to participate in both. We're just going to keep driving improvements in the quality of business across.
And the custom manufacturing usually is pretty sticky, long-term relationship. How long do these projects last on the branded product side?
So on the custom manufacturing side, I mean, it's years, right? Because once you're in, providing that you don't do anything to screw up, and providing that you keep your customers competitive and with strong quality and great service, you could typically maintain that business. From a proprietary product standpoint, I'll answer your question two different ways. So number one, if it's an off-the-shelf material, that's less sticky because in many instances there are other people out there that can make that same chemistry. So it's really a service level. It's a service level and price level competition play. However, when we can take those base products and then incrementally bend them, twist them, formulate them to solve customer specific problems, that becomes more sticky, more in line with what you see from a custom manufacturing perspective. So, when we say, branded products or proprietary products, for us, there's really kind of two different buckets. One is, when and where can we take something off the shelf and customize that truly to solve a customer problem? That's really where we're leaning in super hard. The other sector, while interesting, is less sticky, right? And it is more price competitive.
Okay. So I'm gonna, since we're already talking about this, I'm gonna put in here the question from the audience,
Sure.
which also asks if you can talk a bit more about your sales process. And yeah, just gonna leave it at that and then include the other questions as well.
Talk about the what, Sebastian? I'm sorry.
The sales process,
Oh,
your
the sales
sales process. Yeah.
Yeah, for sure. So, I mean, let's start off on the front end. So, when we came into the company, part of our challenge was understanding what we had. So, we stood up a marketing organization, and as a part of that, we have market research. So, really, what they did is they took a look at the products that we actually had on the shelf and really identified what markets and what applications could they be used in, and then of that, what's the relative prospective customer base. They take that information, they feed that off to our inside sales group, who then follows up by phone and chases people down to understand if there's a potential match. And if there is, that's when the technical sales organization comes in. They take those pre-identified opportunities and they work with the customers to move that through the selling process. So once there's a defined need, customer expressed defined need, that's when it enters into the overall pipeline. From there, depending on that particular opportunity, generally speaking, it starts off with kind of that pre-qualification. We move into sampling. From sampling, it moves into customer qualifications within their lab. Once it passes that, it goes into field testing in many instances where they demonstrate the efficacy of the products that we're manufacturing in the commercial scale, in the real world applications. And then from there, moves into contracting, negotiation, and then final commercialization. So I said all of that in a really short period of time. However, it is a generally lengthy process, which is both, again, the good news and the bad news. Because once you're in, providing you don't do anything to screw that up, you're in.
Is there any target in terms of onboarding new customers, closing sales, how long the sales cycle, what do you aim for in terms of months or years or perhaps decades?
That's a difficult one because it is really opportunity dependent. What I would say is, look, if we can get custom manufacturing opportunities, below, inside of a year, in that 6 to 12 month range, I would be delighted. If we can get our proprietary products in the range of 3 to 6 months, I would be absolutely delighted.
Hmm. Okay. And for existing customers, is it much shorter than for new customers, or
No,
is it
really,
kind of okay?
no. It's the same process rigor, right? Even if it's an existing customer, while you might have that relationship and that level of trust, there's still the bench work that's really required to demonstrate that our products work and their products and applications.
Yeah. Okay. I mean, you already said for custom manufacturing, once you got the relationship, it's usually years that you work with that customer. For branded products, if you modify the formula, are we also talking about years, or what is kind of the typical customer
Yeah, generally
relationship
speaking.
there?
Yeah, generally
Okay.
speaking, if there's a level of customization, it's
Mhm. Okay, perfect. Then I'm gonna go to the next question here from the audience, which asks you about the industry growth, which obviously I think the chemical industry is still kind of in the bottom of their historical numbers. So what do you look for in industry demand to improve? Well, I guess the question is, do you rely on industry demand to improve? And to improve your overall business and probably in terms of achieving your goals, I guess.
No, I mean, if our business strategy was underpinned by assumed market growth, we should probably just fold up and walk away, right? So everything that we're setting out to do is just through an aggressive level of self-help. The market across all of the segments, generally speaking, has been incredibly soft. And what I would say is, the forecast rolling into 2026, just read a publication within the past 1 to 2 months from the ACC, the American Chemistry Council, and they're actually forecasting just broad market contraction, not to a great extent. It's less than 1%, but still not a lot of green shoots in the horizon for broad-based strong market recovery. So it gets back to what are we doing, right? Again, our business strategy is not underpinned by underlying market growth. If and when that does happen, that'll be awesome, right? We'd love to have that tailwind because that's only going to help us, but that's not something that we plan on.
Okay. I think we spend a lot of time talking about organic growth. Maybe we can touch a bit on your capital allocation strategy in organic growth. So first question, I mean, you bought back 60% of the shares outstanding. You haven't done any acquisitions so far. So how do you think about deploying the remaining 60 million in cash?
Yeah, so you're right. We did buy back 6% of our outstanding shares, and that's really underpinned by the fact that we have enormous confidence in where we're going and the team that we put in place and what we believe the future holds for us. But of the remaining $60 million, number one, I would love for our commercial team and quite frankly for our operations team to be hitting me every day with opportunities to deploy that cash internally inside of our existing fence line. Maybe there's a customer growth opportunity that we can't quite wrap our arms around unless we have additional equipment. I love those type of opportunities. Bring me a compelling ROI, and we're more than happy to invest in that. Additive to that are also opportunities for us to drive automation inside of our plants. Automation within batch manufacturing is a little bit difficult. It's a little bit different. That doesn't mean that it's not possible. So we've really challenged our operations organization, because for many years, they were encouraged to run with duct tape and popsicle sticks and very little reinvestment, and quite frankly, discouraged from, really kind of stepping back and looking at things differently. We've taken a different approach to that and really started to challenge them to think about what automation levers could actually help them improve our cost, improve our reliability, improve our quality. So optimistic that new opportunities will emerge through that exercise as the plants really settle in to the new world order. And then finally, M&A. So late last year, we were a little bit ahead we're a little bit further along in the turnaround journey than what we thought we were going to be. Late last year, we dipped our toes in the water from an M&A perspective. We're actually under LOI. It was a very, very small transaction, less than a $5 million valuation. And we got into diligence. We saw some things we didn't like. We tried to retrade, and ultimately we couldn't come to terms, and that's okay, right? We walked away, and that was okay. We're not going to go buy things just for the sake of buying things and growing the size of the company. For us, it's about the quality of the business ultimately. So we've been allocating more of our time and energy, especially after the sale transactions completed, to really beginning to shape up that pipeline or that funnel and beginning to effort that. Don't have anything to announce today, but again, we're actively working on that, and we're looking at it through the lens of those strategic filters, Sebastian, that I mentioned earlier, right? So complementary from a market participation, complementary capability. So we'd like to bolt things on that we don't have today, so we can approach our customers with more tools in the toolbox, if that makes sense. And then there's a geographic element or filter as well.
I want to pick up on something you mentioned. You said you were ahead on your internal turnaround strategy. Like you were further ahead than you thought you would be. So what are kind of your internal goals that you set out where you said, okay, first, maybe you got to put the people in place, second, third, etc. So maybe you can share a bit of what that checklist looked like when you arrived 1.5 years ago.
Yeah, I mean, look, the checklist, the first three things on the list were people, right? So get the right team, get them put in place and make sure that they have the runway to do what they do best. And that's really what Ryan and I focused in on from day one. And we assembled the team pretty quickly, right? It wasn't overnight, but you can't deliver the results that we delivered in such a short period of time without having that foundation in place. And so that's what we tackled from day one. But there are also other levers that come along with the people component. So an example that I gave earlier about strategic sourcing, you bring the right strategic sourcing folks in, you give them the keys to do what they do best, and then you set pretty aggressive expectations around what's expected at the end of that. My own personal expectation was not that we were going to be able to strip out 20% of our raw material cost next year, honestly, right? It was actually a little bit less than that. So they exceeded my expectations. But to me, it kind of gets back to what I've seen throughout my career, right? You get the right people, you give them the keys, you equip them with the right people or with the right processes and tools, and ultimately you're going to be surprised with the results that they actually post at the end of the day, because they're empowered, they're equipped to do what they do best. So again, people, to answer your question, and from people, everything kind of follows from that. A couple of other antidotes though, Sebastian. So, one of the things that we saw, it wasn't easy for us to get our hands on data. And we're really data-driven guys, right? Data-driven decision-making is really super important for us. And the fact that we had 2 different ERP systems and we had no reporting repository, that was a critical imperative for us to address. So we addressed, part of that immediately, which was, getting our hands on data. And then over time, we efforted a conversion to one ERP environment. And actually, we just completed that over this weekend. Folks walked in on Monday morning. They pushed F9 or whatever the right button is on the system, and they were able to log in, and we were able to collect cash. We were able to issue purchase orders, post-production, record shipments, create invoices, and the like. So, a lot of that stuff, we tend to kind of take for granted, but you hear about companies that, are brought to their knees on failed ERP implementations. That gets back to the quality of people that we're bringing in.
Yeah, I assume when you came in as CEO, you also had some turnover in terms of personnel,
Oh, yeah.
and obviously a lot of people who, well, maybe stayed with the company, who have been there since many years, experienced a lot of different CEOs probably. So what was kind of the overall reaction of the employees when you stepped in as a CEO, and also kind of probably did things differently than they used to be done in the past?
Yeah, I mean, I think I'm just going to be direct, right? So I think the overarching theme was we don't like you, we don't know you, and we don't believe a word that you say, right? And I think that's fair and appropriate. However, you fast forward a year and a half into it, and while some people might not still like me, they absolutely trust me and they believe what we say. And the reason why is because we back our words up with action. So what our employee base has seen over the past year and a half, is we went from an environment where there was no defined employee bonus program. Just as an example, guess what? There is today, and every single employee is impacted with that. So that's number one. Number two, we said that we were going to reinvest in people. I don't believe you. Okay, well, we've done that, right? That's undeniable. And they've seen the quality of people that we've been able to identify, attract, recruit, bring in, and they've seen the result of those hires. So folks are, really beginning, our employees are really leaning into to Ascent. They love the fact that we're a pure play specialty chemical company. They love the fact that when they wake up in the morning, they're not confused by the company that they work for. And, we're just getting a lot of mileage out of that. When we have town halls and kind of sidebar conversations, I talk about three loves, right? Do I love my job? Do I love the company I work for? And do I love the people that I work with? And as long as those three loves are in balance, life is generally good, and everything else is going to kind of fall in place. And I think we're getting to a point now where that's generally true. There's a level of passion and excitement that our customers see when they walk into our manufacturing plants. Here's another antidote. Over the past quarter, right, inside of Q3, we've had 11, right? By the end of this quarter, we'll have 11 customers visiting our plants. And that doesn't happen just because they want a field trip, right? You make that investment, right? Because it's an investment in time and it's an investment in dollars, because there's a very real business opportunity and a perceived need and a desire to work with Ascent. And when their customers come to our plants and they engage with our employees, whether they're in engineering or operations or site logistics or wherever, they love that, right? And I love that.
Perfect. Maybe last question. You already touched on it in the slide, but I'm just curious, what is your 5 to 10 year goal? Where you would like to see Ascent in 5 years' time?
Yeah, I mean, look, 5 years from now, 2030, I'd like to see us, be at least a $500 million top line company, but more importantly, the quality of the business changing materially to be in that kind of 15% EBITDA range. Through that process, I think we're going to do some really cool things for our employees. With growth comes opportunities that they can't even imagine today. So I think you're going to see an organization continue to lean in and buy into that strategy, and we're gonna start delivering some pretty interesting results to hopefully the delight of our shareholders and to the delight of our customers and the communities that we operate in.
Perfect. Adam, do you have any more questions? That's it for my part, from my side.
Yeah, thank you so much, Sebastian. Really appreciate that. I think that's a great place to wrap it up. Brian, thank you so much for being here and for all the color on the business. Really comprehensive and insightful. Certainly a lot to dig into for our members. And I want to thank everybody else for participating. And as a reminder, as soon as the recording is available, we'll post it on YouTube and distribute that to you, Brian, as well. So just want to say thank you again very much, Brian and Sebastian. This has been great, and we really appreciate you joining today.
Yeah, really appreciate it. Thanks, Adam. Thanks, Sebastian.
Thank you.
All right, thank you. Take care.